Dear friends and investors, as you all know that the earnings season is in full swing. The results for the third quarter of the financial year 22-23 are beginning to trickle in, and we are going to talk about some of the trends that we are seeing in some of these results that have already been announced. Particularly, we will talk about three sectors. These are all large sectors and sectors where we have exposure in our portfolios. We will talk about IT services and technology. We will talk about banks and financial services, and we shall talk about automotive. So what happened in IT services? As you all know, after a fantastic showing in 2021, in 2022, most IT services companies corrected anywhere from 10 to 40-50%. And the correction in the stock prices of IT service companies was because of two or three reasons. One, there was the collateral impact of a severe correction in the Nasdaq last year. And typically people tend to correlate what happens in Nasdaq to IT services companies in India, though that may not necessarily be sustainable or true over the long run, but the fact remains that there was some collateral impact of that. The second reason was that there was a fear that there would be a slowdown in tech spending because there is an expectation of a slowdown or a recession in the large markets for these IT service companies, which is US and Europe. And third was that would there be an impact on margins, therefore, of these companies. Now let's see what has happened. While we have all seen and read the news about significant cutting of employees by some of the tech companies in the US, which has made big news, Microsoft, Google, Facebook, or Meta as it is now called, Amazon, and many other large tech companies in the US started cutting people aggressively. And there was a fear that if these companies are cutting employees, which means that they expect a significant slowdown, and that could rub off onto IT service companies. However, nothing like that seemed to be impacting the results that we have seen in Q3. In fact, there was too much pessimism that was priced into IT stocks. And when the results actually came in, what did we see? The top line growth of these companies were in line or slightly better than expected. Secondly, all the companies showed a reasonably robust growth in deal wins or order books or TCV, whichever way you name it, which means that there is reasonable visibility of growth about the future. Secondly, the margins of most companies actually improved for two reasons. One was that there was operating leverage. Two, there was a currency benefit. And three, we have seen attrition rates come down, and hence companies were able to protect their margins. And therefore, we believe that the structural story of tech spending that we have been talking about is largely protected. In fact, a very interesting trend that we saw in the IT results was that there was a lot of fear that with European countries going into a deep recession given the energy crisis, Europe would significantly impact the tech spending. But that hasn't happened. In fact, the European geography business for most of the IT service companies did better than expected and even better than the US. And if you think why that happened, as we said last year, that when the economies in the West go through a problem, companies want to cut costs and improve productivity. And one way of cutting costs is to actually outsource more. And clearly, Indian companies have benefited from greater outsourcing. Obviously, there will be some sector or the other which would have a challenge in terms of lower budgets. But on the whole, I think the IT services companies have come out pretty strong. Especially if you look at the areas of ER&D where we have significant exposure, those companies have actually done phenomenally well. Whether it was Persistent, whether it was Tata Elxsi or KPIT, they have all shown good deal wins and good numbers. And for the entire tech pack, we have seen that the stocks have actually rebounded post a correction last year. In fact, if we looked at the trends of the US banking industry, because they are one of the largest spenders on technology, and none of the big banks have actually called out that they are cutting spending on technology because they believe it is very, very central to their business and to their future. So therefore, I think that we look to our investments in IT services with the same level of conviction that we've seen in the past. The worst clearly seems to be behind us. Excessive fears about a slowdown and margin cuts, in our view, were unwarranted, but we have to respect the markets, and we are happy to say that most companies have delivered in line or better than our expectations. The second large sector is banking. Banking actually had a spectacular year in 22, and most companies that have declared results have actually more or less beaten expectations. We've seen improvement in the net interest margin, which is the difference between the yields at which you lend money and your cost of funds. And we've seen that because the asset side gets repriced when interest rates go up, the deposit rates take time to go up, your margins have actually expanded. We've also seen a very solid advances growth year on year as well as quarter on quarter, and therefore credit growth continues to be reasonably strong in the system. However, it is quite possible that today your advances growth is running faster than your deposit growth, and therefore there will be a war for deposits, and it is quite possible that deposit rates have already started to harden a bit, and maybe this fantastic margins that the banks have seen may top out in the fourth quarter, and there could incrementally be a little bit of pressure. Nothing that we need to worry significantly, but I think that the best of the banking results will be there in the third quarter and the fourth quarter, and then next year things should stabilize and normalize. And just like it happened in tech, there was too much of pessimism, the results were fine, stocks rallied. In banking, there was too much of optimism, results were great, but stocks corrected, right? There is also another reason why banking stocks have corrected, and that is because of what we have seen with one of the large groups in India, which is the Adani Group. While a large part of the Adani borrowings are either with foreign banks or bonds, and the exposure to Indian banks is probably 1/3 of their total borrowings, and largely with public sector banks. There is some exposure with the private sector banks, but it is not excessive. And most of these banks have created enough provision in their balance sheets to tackle any untoward incident that might happen. But sentimentally, it has definitely impacted the stock prices of banks. However, the banks that we own are very well placed, their balance sheets are strong, their provisioning is strong. Luckily, we do not have any exposure to public sector banks, even though I believe that public sector banks may also not have a problem, but their exposure is larger than the private sector banks. So I think incrementally post this sentimental correction, the fundamentals of the banking system continue to remain reasonably robust, and especially the banks where we have an exposure, and therefore we have nothing to worry. We believe that after this correction, the banks will continue to do well, and we are reasonably safe and happy with the exposure that we have. Coming to the third sector, which is autos. Autos also turned in a very fantastic picture when it came to Q3 results. The numbers more or less were better than expected. Margins across all auto companies improved on better average realizations and softer commodity prices. The higher ASPs can be attributed to judicious price hikes that these companies have taken and a better mix. And that is also reflected in very strong PAT growth. And we believe that the auto sector should continue to benefit also into this year as well. And we continue to be confident about our exposure to the automotive companies. We will now talk about a few hits and misses on some of our large holdings for the results, some of the results which have already come out. ICICI Bank, picture perfect numbers, very strong NIMs, profit growth, and virtually no provisions for NPLs. You can't get it any better. We believe that the bank continues to deliver very solid numbers and is on a strong footing and a steady growth path. The second company where we had a significant hit, when I say hit means it was not a miss, it was actually a better result than what we expected, was Tata Elxsi. As you know, we had a large exposure there. We have trimmed our exposure and taken some profits off the table. Yes, Q2 was a challenging quarter for them. They had some squeeze on margins, and one of the verticals, which is the media and communication, was slowing down. However, this quarter was actually far better than what we expected. And the automotive division did all the heavy lifting, showed very strong Q-on-Q numbers, and so also their design division. We believe that the worst is behind us, and Tata Elxsi should continue to show robust Q-on-Q growth going forward. They were also able to improve their margins in Q3 as compared to Q2, as they reduced outside contractors and used most of their internal trained employees, and hence were able to manage the EBITDA margins and also benefited from the currency depreciation and the appreciation of the pound and the euro. The third company was Reliance. Reliance also, despite the fact that there was a windfall tax that was put on them, showed very good O2C performance, which is the oil to chemical division did very well. And Geo and retail actually gave very, very robust top line and EBITDA numbers. Each segment has improved quarter on quarter. We believe that Reliance continues to execute phenomenally well. The balance sheet is strong, and we look forward to they executing on their new energy growth plans. The fourth was Axis Bank. Just like ICICI Bank, Axis also showed very strong numbers. In fact, much better than what the street expected. Very strong net interest income, NIMS, PPOP, and the CASA was also reasonably healthy, and there was a margin expansion. We believe that as the Citibank card business that they acquired goes into execution mode, they should continue to do well as well. The fifth one is Persistent System. Persistent, in fact, stood out amongst all the IT service companies. They had superb margin expansion, very strong top line growth, and very healthy deal wins as well. And we believe that Persistent should also continue to outperform as we move ahead. So these were the 5 companies where we had great hits. Now let's come to the misses. Which were the companies which didn't deliver as per our expectations? One was Avenue Supermart. As you know, Avenue Supermart runs the DMart stores. What was disappointing for us? Margins disappointed. And why did the margins disappoint? And that is because if you look at the DMart as a business, they do general merchandise, which means the usual FMCG products that they sell in their stores, toothpaste, coffee, tea, soaps, so on and so forth, stuff that we use almost every day. But they also sell apparels and general merchandise, right? Kitchenware, small, stuff that is a little more discretionary. And in their mix, while FMCG did quite okay, the discretionary part of the sales have not yet recovered fully from the impact that we saw post-COVID. And that largely may be due to the fact that the kind of target audience that they deal with has probably seen the adverse impact of inflation. And therefore, the consumer is only spending what is absolutely necessary. Now, we believe that this is not a structural decline, but it is temporary, and we do believe that over the next few quarters, as inflation comes down and as incomes are rebuilt, general merchandise in the mix will also improve. Also, one of the disappointment was that they opened only 4 new stores in the quarter. They typically tend to open 10 to 12 new stores, but it's quite possible that there was probably some lead lag impact, and we hope that in the fourth quarter, the rate of improvement in new store openings should go up. So we like the business. We think it's a very well-run company, but we saw disappointment in store openings and in margins, and we will monitor this, and we hope that that gets corrected over the next few quarters. The other miss was United Spirits. As you know, United Spirits is a leader in the liquor industry. They have some of the best brands, and recently they did a big restructuring of the business where they took the low-end brands and exited that business because they want to only focus on the premium brands that they have. Now, what happened? If you look at the trends on premiumization, volume growth in the premium segment did very well. There was a 4 to 5% volume growth, and realizations also did well. However, as the divested business profits are no longer in the P&L, obviously the absolute EBITDA declined, but we believe that that is the right thing to do. We think that the company focusing on a premium portfolio is the right thing to do in the long run. As you also know that the liquor is a very, very complex business. When your raw material costs go up, you need to go to each state government and ask for a price hike. Now, some of the state governments have already given a price hike, but some larger states have yet to give them a price hike. We believe that those price hikes are just a matter of time. These price hikes should also come through over the next few quarters, and the company has put together a very strong supply agility program to cut cost, improve productivity, and focus on top-end brands. We continue to be very, very confident about United Spirits despite a challenging quarter. We think that their leadership position is intact, their strategy is right in terms of the future direction, and we continue to hold that investment. The third miss was Dixon. Now, Dixon, as you know, is the largest company in electronic manufacturing space. They are a B2B business. They do contract manufacturing in several sectors: mobile phones, air conditioners, lighting, washing machines, TVs, etc., and fits in very well with the government's focus on getting more and more electronic components manufactured in India. However, this quarter, from a top line perspective, was significantly soft because of two reasons. One was that LED TVs and mobile phone offtake had reduced. We have seen that globally, smartphone shipments have come down, and their customers, which is Motorola, being one of the large customers, did not offtake the number of mobile phones that was earlier anticipated or expected. And therefore, there was a big miss on the top line growth, much more than what we had expected. However, the good news is that margins actually improved. They had a pressure on margins, and as we had spoken in the last few quarters, that as raw material and commodity prices have gone up, many companies have faced margin pressure. Similarly, Dixon also had margin pressures in the last 2 quarters, but in this quarter, they were actually able to improve their margins. Now, what happens with the top line miss? Well, it's unfortunate, but the good news is that Dixon is in advanced negotiation with 2 very large customers who will give them additional business on cell phones. And we believe that once Dixon gets these orders for 23-24, their mobile phone business should come back. Our independent channel checks also show that after the tapering off of demand in mobile phones in the third quarter, January has seen some pickup in demand for mobile phones. And we believe that as 5G gets rolled out in India and across the world, should aid the demand coming back. Structurally, Dixon is a very, very strong player, one of the leading players in the electronic manufacturing space. And while investors, including ourselves, were very disappointed with the third quarter numbers, we think that there is nothing structurally wrong. It was a particularly bad quarter for 2 of their product lines. The rest of the product lines did very well. The margins were protected and improved upon. And we believe that as they win new customers in the mobile phone business, next year should be a very, very strong year for Dixon. So with this, I think we have been able to give you a fairly good sense of the hits and misses, and we will talk about more such as the subsequent results roll in. Lastly, I do want to talk about another topic which is very well discussed today, which is what is the impact on India of China opening up? As you know, China had the longest period of lockdowns because of COVID. We had 2 years of lockdown and opening up, but China lockdown lasted for a good 3 years. And now finally, after the Congress, they have this Politburo in China which meets, and where Xi was re-elected in November. And post that, China decided a big U-turn and decided to open up the economy dramatically. And therefore, what is the impact? The first thing is that, as you all know, as the economy, when you open up an economy, there is a surge in demand, right? And therefore, there is a lot of optimism about that China growth will rebound because of the opening up. And as you know, last year, the Chinese markets were horribly down, and India outperformed China by a big mile. And therefore, one of the impact is that FIIs are now selling some of their holdings in India where they are making substantial profits and moving their investments to China. So it is quite possible that in the first 1 or 2 months of this calendar year 2023, some of the money that was expected by FIIs to come into India and emerging markets in general may incrementally go to a market like China, being a large emerging market. And we have seen that in January, FIIs have sold aggressively. And one of the reasons could be that they could be moving money to China. Again, we believe that these relative valuation moves are not something which is long term. It could impact flows into India for, let's say, maybe 1 or 2 months, maybe a quarter at best. And then India's long-term attractiveness should get FIIs back into the Indian market. However, in the near term, it could pose challenges for outflows from FIIs. The second impact is that as the China economy opens up, consumption should boom in China, like it happened in India. People start traveling, people start going out, eating out, going to movies. And the Chinese have saved for the last 3 years. And now they would also want to go out and spend that money. And there is a fear that that would mean that commodity prices may start to rise again, and that could impact inflation. We will have to wait and see what impact that has on commodity prices. So far, commodity prices have remained benign. Oil prices have corrected. And despite the early opening of the Chinese economy, we haven't seen a substantial pullback in commodities. But that is one thing that we would need to monitor, as pent-up demand in China results in very strong consumption. So with this, we've discussed and covered a lot of ground. I think next month when we meet, the budget would have been out of the way, and we will come back to you and talk about the rest of the results, how it fared. But with that, thank you for your patience. Until the next time. Bye-bye.